If you're saving money for the short term, like a car repair, a move, taxes, a trip, a down payment, or just, I want peace of mind, the goal is not to chase returns. The goal is to keep your money, 1, safe, 2, available, 3, and organized, so you don't accidentally spend it or lock it up. Today, I'll show you exactly where to keep short-term savings so you don't lose liquidity, using a simple liquidity ladder and a bucket system. This is educational content, not financial advice. Let's start with the most important idea. Short-term savings is not investing. If you might need the money within the next 0 to 24 months, your top priority is liquidity, meaning you can access the cash quickly without taking a loss or paying penalties. So the question is, where should that money live? Here's the liquidity ladder from most liquid to least liquid. Level 1, checking account. Level 2, savings account, including high-yield savings where available. Level 3, time deposits like CDs or simple term deposits. Let's break these down with real-world pros and cons. First, the checking account. A checking account is for operations, paying bills, daily spending, transfers, and immediate access. It's perfect for money you'll use soon, like this week or this month, because you can move it instantly. But checking is usually not ideal for storing a big chunk of short-term savings for months, because it's easy to spend and often earns little or no interest. So here's a rule of thumb. Keep your life operating money in checking, typically 2 to 4 weeks of expenses, not your entire savings. Second, the savings account. A savings account is where short-term savings should live in most cases. It's still liquid, but it adds a helpful friction. You're less likely to spend it impulsively. This is also where most people store an emergency fund and money for near-term goals. In some countries, you'll see high-yield savings accounts. That's basically the same idea. Cash savings with better interest while keeping access. The key concept is it's still savings, not investing. Third, time deposits, like CDs or term deposits. These can pay a fixed rate, which sounds great, but there's a trade-off. You lose liquidity. If you withdraw early, you typically pay an early withdrawal penalty. That means you should only use a time deposit for money you truly won't need until the maturity date. So if you're building short-term savings and you need flexibility, time deposits are not your main tool. They're optional for the portion of money you can safely lock. Now, before you choose anything, you need to think about safety and protection. In many countries, deposit accounts at banks are protected up to certain limits. For example, in the US, FDIC deposit insurance generally covers up to $250,000 per depositor, per insured bank, per ownership category. And it applies to common deposit accounts like checking, savings, and certificates of deposit. If you use credit unions, the NCUA provides similar coverage up to $250,000 at federally insured credit unions, including savings and time deposits. In the EU, deposit guarantee schemes protect up to $100,000 per depositor, per bank. You don't need to memorize these exact numbers, but you should remember the principle. Short-term savings belongs in insured low-volatility deposit accounts, so you can access it without surprise risk. Now, let's build a simple system you can use immediately, the bucket method. Instead of one pile of money called savings, you create buckets with names and rules. Here are 4 buckets that work for almost everyone. Bucket 1. Monthly operations. This stays in checking. It covers your normal monthly spending and bills. Bucket 2. Emergency fund. This goes in savings. It's for real emergencies, unexpected bills, or income disruptions. Bucket 3. Short-term goals. Also savings. This is for planned expenses in the next 3 to 24 months. Travel, taxes, insurance, school, a move, car maintenance. Bucket 4, lockable cash. This is optional. If you have money you truly won't touch for a set period, you can place a portion in a time deposit. but only after buckets 1 to 3 are covered. When you do this, you stop guessing. You don't feel guilty spending money that was meant for a goal because it's separated. And you don't accidentally spend your emergency fund because it has a clear label and clear rules. Now here's the practical guide for choosing where to keep your short-term savings based on time horizon. If you'll need the money in 0 to 30 days, checking. If you'll need the money in 1 to 6 months, savings. If you'll need the money in 6 to 24 months, mostly savings, and optionally a small portion in a time deposit, only if you're confident you won't touch it early. Now, let's talk about the mistakes that cause people to lose liquidity. Mistake number 1, putting short-term money into volatile assets. Stocks and crypto can drop exactly when you need cash. That's not a strategy. That's a risk. Mistake number 2, keeping everything in checking. It's too easy to spend, and it usually doesn't pay much. Your savings should not be sitting in the same place as your daily spending triggers. Mistake number 3, locking too much into time deposits. Then life happens, you withdraw early, you pay a penalty, and your safe plan becomes expensive. Mistake number 4, not naming your money. When money has no purpose, it becomes easy to spend for the wrong reason. Buckets fix that. Now you might ask, what about inflation? Isn't cash losing value? Yes, cash can lose purchasing power over time. But the solution is not to gamble your short-term savings. The solution is to use the right tool for the job, cash for short-term liquidity and investing for long-term growth. Your system should have both, but they shouldn't be mixed. So here's a simple 10-minute action plan. Step 1, decide your operating amount, 2 to 4 weeks of expenses, and keep that in checking. Step 2, create an emergency fund bucket in savings. If you're starting from 0, start small. The first goal is consistency, not perfection. Step 3, list your next 3 to 5 upcoming expenses over the next 12 months. Taxes, insurance, travel, maintenance. Create a short-term goals bucket in savings and contribute monthly. Step 4, if you have extra cash you truly won't need, you may choose a time deposit for that portion, but only after steps 1 to 3 are stable. Step 5, automate it. Automation is the difference between I'll try and it actually happens. Finally, keep it measurable. Once per month, check 3 numbers. 1, how much is in operations? 2, how much is in your emergency fund? 3, how funded your short-term goals are. That's how you protect liquidity and build stability without overcomplicating your life. If you want to manage buckets, track monthly totals, and keep your short-term goals organized in one simple dashboard, you can use X Plus Finance as your personal control panel. Thanks for watching.